Hello everyone, welcome to FinTalks. This is Dr. Harikarri, PhD in Finance, having 22 years of experience in teaching and also industry. So this is my fourth video for the capital budgeting series. In my previous three videos, I was explained about various capital budgeting methods, tools and techniques. The capital budgeting methods are basically classified into two categories: traditional methods, which are called as non-discounted cash flow methods. Under that, I was explained along with solving the problems. The two methods are payback period method and ARR, accounting rate of return or average rate of return method. The second category is discounted cash flow method, modern methods, or it is also called as time adjusted methods. Under discounted cash flow methods, I explained three methods, that is NPV, net present value method, PI, profitability index method, and IRR, internal rate of return method. In previous three videos, I was explained about all the methods, and in this video, I am going to solve some examination problems and solutions, including all five methods. So in this video, I am going to solve some examination problems using capital budgeting techniques, tools or methods. So let us start the first problem taken from the examination paper. A company is considering an investment proposal to install a new machine. The project will cost 50,000 rupees and will have a life and no salvage value. Tax rate is 50% of the company, follows straight line method of depreciation. The net earnings before depreciation and tax is follows 5 years, and EBDT, earnings before depreciation and tax, is given. Evaluate the project by using PBP, payback period, ARR, average rate of return, NPV, net present value method, IRR, internal rate of return method, and PI, profitability index method. So this problem, you have to evaluate this project using all five methods are covered. PBP and ARR, that is traditional methods. NPV, PI and IRR, that is modern discounted cash flow methods, both are covered here in this question. So before solving any question, first we have to see cash outflow, that is cost of the project. Yes, the project cost is 50,000, only project cost. Is there any additional working capital? No. Is there any salvage value? No. And next, life of the project 5 years. And now cash inflows. Whether the cash inflows are given in the question directly or indirectly. Normally cash flow, cash inflow, cash flow after taxes. That means direct values which we need to solve the problem. But what is given here in this question? EBDT, earnings before depreciation and taxes. But what we need? For all the methods except ARR, we need cash flows, cash flow after taxes. Only for ARR method, we need profit after tax or earnings after tax we need. So here in this problem, cash flows are not available directly. So you have to extract, you have to calculate cash flow after taxes. So how to calculate cash flow after tax, CFAT from EBDT? This I was explained by using a table here. Solution table. Let us see here. First year, column 5 years. Second year, EBDT values. What are the values? First year 10,000, second year 11,000, third year 14,000, fifth year 15,000, and sixth year and fifth year 25,000. Yes. Depreciation. So from EBDT, if you minus depreciation, you will get EBT, earnings before tax or profit before tax. From EBT, you have to minus tax at the rate of 50%, then you will get EAT, earnings after tax, or PAT, profit after tax. Then for EAT, if you add depreciation, then you will get CFAT. What about depreciation? We don't know the depreciation value. Let us calculate here depreciation. So how we will get depreciation value? Depreciation equal to, we don't know the depreciation, so depreciation is equal to cost of the project divided by life of the project. If you have any scrap value, we will minus that, but there is no scrap value. So there is no scrap value, and let me change the color, this one. Yes, so that equal to, how we will get cost of the project is, how much cost of the project? 50,000 divided by life of the project 5. If you have salvage value, you have to minus from the cost, but there is no salvage value here. That equal to 10,000 per annum. This is the depreciation. So depreciation is straight line method. Every year remain same, 10,000, sorry, 10,000 per annum. So that is 10,000. So earnings before depreciation and tax minus depreciation will give you earnings before tax. 10,000 minus 10,000 nil. 11,000 minus 10,000 1,000. 14,000 minus 10,000 4,000. 15,000 minus 10,000 5,000. 25,000 minus 10,000 15,000. In the single method, I am going to calculate all 5 methods, single problem. Tax at the rate of 50%. So tax at the rate of 50% on EBT. On EBT. EBT is nil here. So tax is also nil. Then EBT tax at the 50% on 1000. That is 500. 50% on 4000. That is 2000. 50% on 5000. That is 2500. 50% on 15,000, that is 7,500. So now EAT, how we will get EAT? Earnings before tax minus tax. First year, nil first year. Then 1,000 minus 500, 500. 4,000 minus 2,000, 2,000. 5,000 minus 2,500, 2,500. 15,000 minus 7,500, 7,500. And last now CFAT, cash flow after tax. How you will get CFAT value? Earnings after tax, EAT plus depreciation. So here 10,000, 0 plus 10,000, 10,000. This is here, sorry, CFAT first. How you will get CFAT? EAT plus depreciation. So here nil plus 10,000 is 10,000. 500 plus 10,000, 10,500. 2,000 plus 10,000, 12,000. 2,500 plus 10,000, 12,500. 7,500 plus 10,000, 17,500. So we have cash CFAT also. In order to calculate payback period, NPV, IRR, PI, we need CFAT, cash flows. So now we calculated the cash flow values available. And for ARR, we take the earnings after taxes, profit after taxes we will take. So let us start with the one by one method. First one is payback period method. As I told in the previous videos, payback period is equal to, so here as I told before, there are two ways to calculate payback period, whether the cash flows are uniform or non-uniform. Here the cash flows are non-uniform. And the cash flows are non-uniform, you have to calculate a cumulative CFAT column, and from cumulative CFAT column you have to apply interpolation formula. So let me prepare the table here. One more table is required here. Insert a table. And Okay, then here first year column. This is the year column we are taking from here. And then what we need, CFAT, cash flow after taxes we need. And then what we need cumulative cash inflow. Cumulative cash inflow is required. Cumulative cash flows are required. This column is cumulative CFAT. Cumulative CFAT. So how we will get cumulative CFAT? First year as it is same 10,000. Second year plus first year value 10,500 plus 10,000, 20,500. Then third year plus third year CFAT plus second year plus first year, all three together 32,500. Then all 4 years of CFAT, that is 45,000. Next, adding of all 5 years CFAT, fifth year cumulative means adding of all 45 plus 55, 62,500. So this is the cumulative column. From this cumulative column, you have to identify where is the cost of the project. Cost of the project is 50,000. 50,000 is lies in between these two years. Up to 4 years, 45,000 is covered. In the 5th year, 62,500 is more than 50. So our payback period is lies in between this 4 and 5. 4 full years and part of the 5th year. What is that part of the 5th year? Let us see by applying the interpolation formula. And 4th year is called as base year because 4 full years completed. 4 full years and part of the 5th year. What is that part of the 5th year? We have to check. So let us take 4th year as a base year. So payback period is equal to PBP equal to base year plus then base year plus the balance to be recovered. Up to 4th year, how much we required? I will write the values. Base year is 4 plus balance to be recovered. Up to 4 years we recovered 45,000 and still 5,000 is to be recovered. Still 5,000 means how you got that cost of the project 50,000 minus 45, 5,000 divided by 5th year CFAT, that is 17,500. Again I am repeating here. How we will get payback period? You have to find cumulative column, find out the base year. This is the base year because 4 years completed and part of the 5th year. Up to 4th year 45,000 is covered. The remaining is part of 5th year. So 4th is base year. Base year plus balance to be recovered. Up to 4th year 45,000 is recovered. So how much is the balance? 5,000. Cost of the project 50,000. So balance 5,000. 5,000 divided by 5th year CFAT, that is again solve it. 4 plus 5,000 divided by 17,500, that equal to 0.28, 0.28. That equal to the payback period is 4.28 years. In 4.2 years we will recover this cost of the project in the form of cash flows. So this is the payback period answer. First one, payback period. And next to second one, what they are asking is second one is ARR, average rate of return or accounting rate of return, ARR method. For all the methods we will consider cash flows. But for ARR method, you will take EAT or PAT, profit after taxes. So what is the formula for ARR? Average profit of formula, I will write down here, formula is equal to average profit, average PAT divided by average investment, average investment multiply with 100, multiply with 100. This is the formula. So how you will get average PAT, whereas average PAT equal to PAT or EAT. Here we have EAT. So PAT, EAT both are same. Earnings after tax or profit after tax, both are same only. Some questions they give as a EAT, some question they give as a PAT. Total EAT divided by number of years, that equal to, what is total EAT? Total of EAT, this is the EAT column. 7,500, 8, 10, 12, 12,500. 12,500 divided by number of years is 5, that equal to 12,500 divided by, so 2,500. This is average PAT. What about average investment? Average investment equal to cost of the project. If you have any salvage value, you have to minus cost of the project divided by life of the project. That is, so what is the cost of the project? 50,000 divided by, cost of the project divided by 2, not life, divided by average investment equal to cost of the investment, cost of the project. If you have money scrap value, you will minus divided by 2. Here there is no scrap value, so 50,000 divided by 2, that equal to 25,000. So now ARR equal to average EAT, that is 2,500 divided by cost of the project, average investment 25,000 multiply with 100, that equal to, so 2,500 divided by 25,000 multiply with 100, that is 10%. So average rate of return of the project is 10%. The formula to calculate ARR stands for average rate of return or accounting rate of return. So accounting rate of return, how you will get average return? Average EAT or PAT divided by average investment. How you will get average EAT? Total EAT divided by number of years. Total EAT, this is the EAT column we took from here. So 12,500 divided by 5 years, 2,500. What about average investment? Cost of the project, cost of the investment minus scrap value divided by 2. Here there is no scrap value in this question. So that's why I took cost of the project 50,000 divided by 2, 25,000. So 2,500 divided by 25,000, 10%, that is the ARR. And now next one is NPV, net present value. Same problem, all methods we are calculating. Net present value, NPV. So what is the formula for NPV? The NPV equal to total PV of CFAT minus total PV of cash outflow. So we have to, NPV is a discounted cash flow method, DCF, time adjusted method. So what you have to do, you have to convert the CFET are future values. We have to convert these future values into present values by applying the table value, present value table at the given discount factor at the rate of return. Here in this question given 10%, NPV at 10%. So we have to convert them, insert a table with the columns, 3 columns, and years. So this is the year column, and this is CFAT. One more column we need. PV at the rate of 10%. That is present value of the tables at the rate of present value of 1 rupee table values at the rate of 10%, and then PV of CFAT. So here are 5 years. All 5 years are there. Yes. Year and CFAT value here. We calculated from the question CFAT. And then PV at the rate of 10%. These tables are already available in Google everywhere. In financial management textbook also they are available. So present value table at the rate of 10%. The values are 0.909, 0.826, then 0.751, 0.683, 0.621. So PV of CFAT. PV of CFAT means CFAT values multiply with table values. The CFAT are future values, we are converting into present values. Discounting we are applying. So 10,000 into 0.909, 90, 10,500 multiply with 0.826, that is 8,000, that is 8,673. Next to 12,000 multiply with 0.751, that is 9,012. And next 12,500 multiply with 0.683, that is 8537.5, round up to 38. 17,500 multiply with 0.621, that is 10,867.5, that is round up to 868. What is next? I want total. So what is the total value of all 5 years? Total PV of CFAT 9,090 plus 8673 plus 9012 plus 8538 plus 10868, that is 46,181. This is the total PV of CFAT. So NPV is equal to, as I told, so NPV is equal to total PV of CFAT 46,181 minus cost of the project, total PV of cash outflow. Cash outflow means cost of the project. and cash outflow is in 0 year. 0 year means it is already present value. There is no need to convert. Cash outflow is already normally in present year only. So that is 50,000, that equal to minus, got NPV in negative, 50,000 minus 46,181. 46,181 minus 50,000. So you got 3,819 negative value. NPV is in negative. NPV is in negative. We got. NPV is in negative. What about PI? Profitability index. Profitability index. PI is equal to total PV of CFAT divided by total PV of CFAT divided by total PV of cash outflow. So that equal to total PV of CFAT 46,181. Just now we calculated by 50,000. That equal to, you got in 46,181 divided by 50,000. 0.92. So as I told before, NPV is in amount. NPV is total PV of CFAT minus cash outflow. That will give you in amount, in rupees. Profitability index is division. That will give you in ratio. So this is the formula of the profitability index. And the next one is IRR, internal rate of return, fifth method. As I explained in my previous videos, internal rate of return will be calculated. Two models are there. One is calculation of IRR along with after NPV, and the second model is calculation of only IRR with the help of the fake payback period, factor location. So here you already calculated NPV. Already NPV is there. So we need one more NPV. In order to calculate the internal rate of return, IRR formula, to apply the IRR formula, we need two NPVs. Already you have an NPV at the rate of 10%. So we need one more NPV. So first of all, IRR, internal rate of return, IRR method. So to apply the IRR formula, we have to apply the IRR formula. To apply the IRR formula, we need two NPVs. Already one NPV is available at 10%. So we will try calculate one more NPV at another rate of return. What is that rate of return? That we have to check. We have to see. How? See here. This is the old NPV. IRR is the rate of return where NPV is equal to 0. It is the rate of return where total PV of CFAT is equal to total cash outflow. So this 46,181 should become 50,000. That means the value has to increase. This value has to increase means the discount factor, the rate of return has to decrease. We have to increase this value. To increase this value, we have to decrease the rate of return. Before we tried 10%, now we try below 10%. Below 10% means anything you can try. 9, 8, 7, 6. Let me try at 8%. PV at the rate of 8%. So let me take the table value at 8%. What is the 8% table values? 0.926, 0.857, 0.794, 0.735, fifth year, 0.681, 681. This is the taken from the table values. And now PV of CFAT. CFAT multiply with present value table. That is, first one is 10,000 multiply with 0.926. That is 9,260. Next to 10,500. 10,500 multiply with 0.857. That is 8,999. Round off. 12,000 multiply with 0.794, that is 9,528. 12,500 multiply with 0.735, that is 9,188, round off. 17,500 multiply with 0.681, that is 11,918, round off. So we have now PV at the rate of 8% table value multiply with CFAT, PV of CFAT, total how much? 9,260 plus 8,999 plus 9,528 plus 9,188 plus 11,918. 48,893 nearest we become. So this is the total PV of CFAT at the rate of discount factor taking 8%. So already we calculated NPV at the rate of 10%. Now we have NPV at another. So based on this we took another NPV at the rate of 8%. So NPV at the rate of 8% is equal to total PV of CFAT 48,893 minus cash outflow. PV of cash outflow means 50,000. That equal to minus 50,000. That equal to 1107 minus negative. So now you have two NPVs in front of you. We have two NPVs. NPV at the rate of, this is NPV at the rate of 10%. Now based on this we calculated one more NPV at the rate of 8%. And now we apply the interpolation formula. IRR equal to 10% and 8% lower rate. Which is the lower rate? Already we did before also formula. Lower rate plus the formula we have. If you want I will write down the formula here. What is the formula we calculated before? Number of times IRR formula is there. This is the interpolation formula we are using. Once you have with you two NPVs, we calculate this one formula, IRR formula. Lower rate 8% and 10%. Which is the lower rate? 8% plus brackets present value at lower rate. At 8%, how much present value? 48,893 minus cash outflow 50,000 divided by PV at lower rate, that is 48,893 minus 48,893 minus PV at higher rate. Higher rate means 10%. Present value of cash inflow, that is higher rate is 46,181. 46,181 multiply with the difference in the rates. Difference in the rates means difference between the 8% and 10%, that is 2. And if you solve the formula, you will get 8 plus in brackets 48,893 minus 50,000 minus 50,000, that is minus 1107 divided by 48,893 minus 46,181, that is 2712. Multiply with difference 2, that equal to 8 plus in bracket 1107 divided by 2712, that equal to 0. Minus, this is minus 0.4018 and multiply with 2, that equal to 8 plus into minus will be minus 0.40 multiply with 2, that is 0.82, that equal to minus 8, 7.18%. The IRR of this project is 7.18. How you got? In order to apply this formula, internal rate of return formula, interpolation formula, we need NPV at two different rate of returns. Already we calculated NPV at 10%. Now I calculated one more time NPV at 8%. How I took 8% is, here we have to increase the value to make it equal to 50,000. We have to increase the value. Increase the value, decrease the rate. So decrease the rate means below 10%. I took 8% and calculated again CF80, PV of CF80. I have NPV now in front of me. I have NPV at 10%, NPV at 8%. Then I use the formula, interpolation formula. Lower rate, that is 8% plus present value at lower rate minus cash outflow, divided by present value at lower rate minus present value at higher rate. If I solve this formula, I got 7.18 is the interpolation formula. This is the formula what we calculated. So in this project, all 5 methods are calculated. Payback period, evaluate the project by using payback period. Normally you will compare the payback period with the standard payback period of the company. If the calculated payback period is below the standard payback period, accept the project, otherwise reject. Coming to the ARR, the ARR of the project will be compared with the rate of return of the company, required rate of return of the company. If the ARR of the project is more than the given standard rate of return, it will be accepted, otherwise rejected. Coming to the NPV, net present value. If NPV is positive, accept the project. If NPV is negative, reject the project. Here NPV is negative, so reject the project. Coming to the PI, profitability index. PI should be more than 1. If the PI is more than 1, accept the project. PI is less than 1, reject the project. Here PI is less than 1, so reject the project. Then IRR. Compare the IRR with the company's minimum required rate of return. If the IRR, internal rate of return, is more than the company's minimum required rate of return, accept the project. otherwise reject the project. But here we don't have any information about the rate of return. So this is the one problem solved by using all 5 methods: payback period, ARR. These two are traditional method, non-discounted cash flow methods. NPV, PI, IRR. These 3 methods are modern discounted cash flow, time adjusted methods. All 5 methods are calculated using the single problem, single mission. And cash flows are not given directly, so we converted the EBDT into CFAT. How? EBDT minus depreciation EBT minus tax EAT plus depreciation CFAT. All methods we need CFAT except ARR method we take EAT. EAT, or it is also called as PAT, profit after tax. So this is the one method. First problem, examination problem solved using all 5 methods successfully. And the next problem is another examination problem is calculate NPV projects given below and suggest which should be accepted assuming a discount rate of 10%. So project X and project Y, 2 projects are there. Initial investment project is cost of the project is given, okay, 30,000. Life of the project is given 5 years. Scrap value, residual value, salvage value at the end of the life of the project is also given 1,000, 2,000. The scrap value is also considered as a cash inflow at the end of the life of the project. Cash inflow after tax. So cash flows are given already, 5 years X and Y. So cost of the project is given and cash flows are given, life of the project is given. You have to calculate NPV at what rate? At a discount rate of 10%. So that is also given, 10% discount rate. Let us solve. But here the important thing in this question is scrap value is also taken as considered as a cash inflow at the end of the life of the project, that is 5th year. In 5th year, the scrap value is also considered as a cash inflow. That is the important thing in this problem. So here project X, cash flow, how much? 5,000, then 10,000, 10,000, 3,000, and here 2,000 plus scrap value is also considered as a cash inflow at the end of the, that is last year of the project. So we have to take 3,000 here. That is the thing here, etc. That is the only point in this question is you will calculate NPV formula, both the projects, everything is same. PV at the rate of 10%, PV of CFAT. But the scrap value is also considered as taken as a, another name for scrap value is residual value, salvage value, scrap value. The amount of scrap value is considered as a cash inflow at the last year of the project life. So here I took 2,000 is the last year and plus scrap value 1,000, total 3,000 I took here. And what about PV at the rate of 10% table values? Already we use here before in this question. So same I am taking here table values. No need to type again. These values I took from the present value of 1 rupee table values, which are available in Google everywhere. In every financial man textbook they are available. Now PV of CFAT. How you will get PV of CFAT? Cash inflow multiply with PV of CF with PV at the rate of 10%, table values. Multiply with 0.909, that is 4545. 10,000 multiply with 0.826, that is 8,260. 10,000 multiply with 0.751, that is 7,510. 3,000 fourth year, 3,000 multiply with 0.683, that is 2,049. And last year cash flow are 3000. Given cash flow 2000 plus scrap value 1000. Total 3000, my dear. So 3000 multiply with 0.621, that is 1863. And what is the total? Total is 4545 plus 8260 plus 7510 plus 2049 plus 1863, that is 24,227. Total PV of cash flow is 24,227. And same calculation we will do for the same calculation project Y. What is the project Y cash inflow? First year 20,000, okay. 10,000, okay. 5,000, 3,000. Last year 2,000 plus scrap value of project Y 2,000. So scrap value is also considered as a cash inflow, keep in mind. And 10% table values, same table values. And now multiply. So first year, sorry, yes. So what is the value first year? How we will get PV of CFAT? Cash inflow multiply with the PV table values. Present value at the rate of 10%. 20,000 multiply with 0.909, that is 18,180. 10,000 multiply with 0.826, that is 8,260. 5,000 multiply with 0.751, that is 3,755. Then fourth year 3,000 multiply with 0.683, that is 2,049. 5,000 multiply with 0.751, yes. And last fifth year is 4,000 we have to take, because 4,000 is 2,000 cash flow and the remaining is scrap value, 2,000 scrap value, total 4,000. So 4,000 multiply with 0.621, that is 2,484. What is the total value? 18,180 plus 8,260 plus 3,755 plus 2049 plus 2484, that is 34,728. 34,728. This is the. So what is the NPV formula? NPV is equal to total PV of CFAT minus cash outflow. You can write total PV of cash outflow. Nothing but it is cash outflow is generally present value only. It is always present value only. Unless there is some additional requirement, initial addition, cash outflow is always in present year only. So now I am calculating for project X is equal to what is total PV of CT? 24,227 minus what is the cost of the project? 20,000. Cash inflow 20,000, that is 4,227. What about project Y? That equal to what is the total P of CAT? 34,728 minus what is the cash outflow? That is cost of the project 30,000, that is 4,728. So the NPV of project X is 4,227. NPV of project Y is 4,728. So which one will choose? Which should be accepted? NPV is maximum high for project Y. So project Y should be accepted. What is the decision is? Project Y should be accepted as its NPV is maximum. NPV, the project which is giving highest NPV, maximum NPV should be accepted. So here project X is 4,227, project Y is 4,722, 728. That's why project Y is accepted. This is another model. Two projects. You have to choose which is the best one based on the NPV. So for NPV, we need cash flows, PV of cash flows. You have to multiply with the present value tables. At what rate? At a rate of at a discount factor given 10%. So we calculate for project X and project Y. But in this question, the scrap value, whatever is there, that value will be considered as a cash inflow at the last year of the life of the project. That's why we added here. That's it. That is the important thing in this question. Remaining all same calculations. And now another calculation, another problem we'll solve. Examination problem is another problem I want to solve. Examination problem is, from the following data state which project is better. Project A and project B. Year 0. Year 0 means cash outflow. 0 year, current year. Year 0 is also called as current year, present year. Whatever the value given in 0 year, it is nothing but cost of the project, cost of the investment, cash outflow. That's why they gave in minus. See, the cost of the project is 10,000 A and project B also 10,000. And cash flows are given directly 3 years. What is the important in this formula, in this problem is, riskless discount rate is 5%. Project A is less risky than project B. The management considered risk premium rate. Risk premium rates are 5% and 10% respectively, appropriate for discounting the cash flows. So we have to take the discounting factor of project A and project B. How much? Project A discount factor is equal to riskless discount rate plus risk premium rate. Risk premium rate, that equal to, what is the riskless discount rate? 5% plus what is the risk premium rate for this one project A? 5. That equal to 10%. Discount factor is 10%. Same calculation for project B. Project B is riskless discount rate 5% plus risk premium is 10% here, 10%. So 5 plus 10 equal to 15%. So here project A discount factor, that is rate of return for table values. Riskless discount rate 5% plus risk premium rate. The management consider risk premium rates are 5% and 10%. So 5% for this one, add 5 plus 5. Riskless discount rate plus risk premium rate, 5 plus 5, 10%. Project B, riskless discount rate already 5% plus risk premium rate 10, so 15%. So here we have project A, we have to take 10%, and for project B you have to take 15%. Table value, present value of rupee table values will be taken from 15%. That is the Important thing in this question. So we have to calculate NPV. In order to calculate NPV, we need a discount factor, rate of return, but discount factor is not available. We calculated. How you calculated? Riskless discount rate plus risk premium rate. Riskless discount rate is 5% for both, but risk premium rate is for A 5%. So if you plus 5%, 5 plus 5, 10. For product B, risk premium is 10%. So 5 plus 10 is 15%. So PV at the rate of 10% table value, PV at the rate of 15% table value, we have to take. And 10% table value already I calculated before also, so it is ready with me. I am taking directly from here, copy paste. And what about the cash flows? How many years it is? Sorry, it is only for 3 years, dear. It is only for 3 years, 1, 2, 3. So very easy, you can calculate. First year 4,000, 4,000, 2,000. Discounting. So what about here project B? 5,000, 6,000, 3,000. And I want table values. PV at the rate of 15% table value. 15% table values are first year 0.870, second year 0.756, third year 0.658. So now PV of CFAT. How we will get PV of CFAT? Cash flow multiply with PV at the rate of 10%. 4,000 multiply with 0.909, that is 3,636. 4,000 multiply with 0.826, that is 3,304. 2,000 multiply with 0.751, 1,502. Total 3,636 plus 3,304 plus 1,502, that is 8,442. And next one, for project B, PV of CFAT. Cash flow multiply with PV at the rate of 15%. Table values. 5,000 multiply with 0.870, that is 4,350. 6,000 multiply with 0.756, that is 4,536. 3,000 multiply with 0.658, that is 1,974. Total 4,350 plus 4,536 plus 1,974, that is 10,860. So this is the total PV of CFAT. And how we will calculate NPV? NPV of project A is equal to, already we calculated many times. What is the formula? Total PV of CFAT minus cash outflow. Cash outflow, cost of the project, whatever you want you can write. Nothing will happen, same. So that equal to, what is the total PV of CFAT? 8,442 minus, what is the cost of the project here? 10,000. So minus equal to 10,000. That equal to, what is the answer? You will get answer in negative. How much it is? 8,442 minus 10,000. That is 1,558 minus negative. Same calculation now for the NPV of project B equal to total PV of CFAT. How much? 10,860 minus 10,000, that is here you got positive value. How much? 860. So here if you check the values, NPV of project A is minus 1558, NPV of project B is plus 860. So which one we will accept? Obviously project B only, because it has a positive value. Decision: project B should be accepted as it gives a positive NPV of 860. Since project B is giving a positive NPV of 860 compared to project A, project B should be accepted. And the important thing in this model, in this problem is, in order to take the discount factor, rate of return for table values, we have to use riskless discount rate plus risk premium rate. So here you got 10% for project A, and for project B 15% you got it. So at two different risk premium rates, if there varies changes, so project B should be accepted. This is an examination problem. Another examination problem taken from the exam paper is, a company proposes to install a mission involving a capital cost of, that is cost of the project 180,000. The life of the machine is 5 years and its salvage value at the end of the life is nil, no salvage value. The machine will produce the net operating income after depreciation of 34,000 per annum. Calculate the internal rate of return of the proposal. So in this question they are asking you to calculate the IRR. In order to calculate IRR, we have to apply the interpolation formula. In order to apply interpolation formula, we need two NPVs. If you want to calculate NPV, we need some discount factor. So discount factor is not available in this question. Discount factor is not available. So what we will do? We will find out the F value. F is fake payback period, or it is also called as factor to be located. Fake payback period you can calculate, that is divided project divided by annual cash flow. We can calculate that one. So first what we have to do? What about cash flow? Cash flow is given in the question? No. What is given? Cost of the project is 180,000. Okay. What about cash flow? The mission will produce the net operating income after depreciation. After minus depreciation is 34,000 per annum. So after depreciation you have to minus tax. Tax value is not given. So first of all let us assume tax at the rate of 50%. We are assuming. And now what is given? Income after depreciation. Income after depreciation is given as is equal to how much given? 34,000. So from this we have to minus tax at the rate of 50%. That is 50% tax is in brackets minus 17,000. So if you minus, what you will get? What value you will get? Profit after tax. That is 17,000. For that again you have to add back. You have to add depreciation. Depreciation we have to add. How much is the depreciation? Depreciation, we'll calculate here. Depreciation is equal to cost of the project 180,000 divided by life of the project 5 years. That equal to how much we'll get? 180,000 divided by 5, that is 36,000. So we have to add back here depreciation 36,000, and then what you will get here if you add back? Cash flow after tax CFAT is equal to, we add here this one, 17 plus 36 is 30, 47, 40, 53,000. We got the value, CFAT value. In order to calculate, we need cash flows. First, cash flows are not available. So how you will get what is given in the question? Net operating income. Net operating income. Income after depreciation. Net operating income. Net operating income after depreciation is given here. From net operating income, let us assume tax at 50%. So 34,000 minus tax 50%. We are assuming tax 50%. So after depreciation minus tax 17,000. The balance profit after tax 17,000. Add back depreciation 36,000. This is how I calculate depreciation. Cost of the project divided by life of the project 5 years 36,000. So add back depreciation, we got 53,000. So now first what I have to do here, F value I have to calculate, fake payback period. Fake payback period, or it is also known as factor to be located, equal to cost of the investment or cost of the project divided by annual CFAT. That equal to, what is the cost of the investment? Cost of the project is 180,000 divided by annual CFAT per annum 53,000. That equal to 180,000 divided by 53,000. That equal to 3.396. This is called as F, fake payback period, or it is also called as factor to be located. So now you will go to present value annuity table. Annuity tables. You will go to annuity table. In annuity table, fifth year 5 row, because life of the project is 5 years. So you will go to annuity table and you will check the 5th year row. In 5th year row, we have to check the row value which is near to the 3.396. You may not get exactly 3.396, but you will get nearest value. So when I am checking this 5th year row, present value of annuity table, year 5 row 3.396 I want, and I found out 3.396, not exactly, but I found out 3.433. It is not possible to get exactly 3.396. So here I have 3.4 nearest value, and the 3.4 I found out under the rate of 14%. So I went to the present value of annuity table. In the table I see the 5th year row, because life of the project 5 years, 5th year row. The nearest value near to the 3.39, 3.4. I found 3.43 on which column? Under the 14% rate of return. So 14%, let us assume as a discount factor. Let us assume discount factor 14% and calculate NPV. From where I got this 14%? This 14% is found from the present value annuity table. Present value annuity table, fifth year row values. If you check one by one, I found out some value near to 3.396. I mean, I got 3.4, and that value is in the column of 14%. In the column 14% rate of return column. So we assume discount factor as a 14%, and let us calculate NPV by taking discount factor 14%. So let us make the table. Just I am copying the table from here itself. Instead of again typing 2-3 times, I am taking the table here. I will delete the values and I will take the table values, everything. And 2 years I required more insert. So fourth year and fifth year, and I have to take PV at the rate of 14%. 14%. This is still not done anything. So I took here PV at the rate of 14%. What is the cash flows given here? Cash flow is same every year, 53,000, 53,000. When cash flow is every year same, actually no need to calculate all 5 times. You can take direct value. But for easy understanding purpose, I am calculating separately. I am taking 53. Every year 53,000 only annual cash flow. And what is the table value? When the cash flows are uniform, every year same, there is no need to multiply 5 times with that 5 time table values. We can take directly. But I am trying here this one. So 14% table value. 14% table values are at 14%. How much is the 14% table values? 0.877, 0.769, 0.675, 0.592, 0.519. And now multiply. Again I am repeating, my dear. When the cash flows are uniform, instead of multiplying 5 times with the each time same table value multiplying, directly you can take the cumulative value you can take. But to make you understand easily, just I am doing 5 times calculation I am doing. That is the only reason I am multiplying 5 times 0.877. Otherwise, there is no need to do 5 times. Directly you can take the annual cumulative table, you can solve it. Because cash flows are uniform every year. 0.769, that is 4757, and next one 53, again multiply with the 0.675, 35,775, 53 multiply with the 0.592, 31,376, 53 multiply with the 0.519, 519, 27,507. Now totals. What is the total? 46,481 plus 47,57 plus 35,775 plus 31,376 plus 27,507, that is 181,896 total. So here what happened, calculate NPV. NPV at the rate of 14% is equal to total PV of CF1 181,896 plus cash outflow project 1,000, that is 8,896 you got. In order IRR follow the IRR formula, what we have to do interpolation for, we need two NPVs. We already calculated NPV at the rate of 1%. We need one more another discount factor. The discount is that another discount factor. How you will try? See here. IRR is the rate of PV of total PV of CFAT is equal to cash outflow. Then 896 also should become 180,000. That is the IRR rate. So if this value to become 180,000 means this value has to decrease. This value has to decrease means rate has to be increased. The value has to decrease. This value has to decrease means the discount factor has to increase. So already you tried 14%. Now you have to increase that 14%, more than 14%. You can try at 15, 16, 17, whatever you want. I will try PV at the rate of 16%. I will try. If you want, you can take 15, 17, anything. I will try at 15, 16%. What about cash flow? Same. Annual cash flows. When the cash flows are uniform, every year same. Actually, no need of multiplying 5 times table. Directly you can take cumulative value. But just to make you understand, same format, every problem, same format I am following. So that's why I am doing 5 times, my dear. So what about the present value table at the rate of 16%? 16% table values are 0.862 and then 0.743 and next to 16% 0.862, 0.743, 0.641, 0.552, 0.476. That's it, 5 years. 476. Now take the calculator, multiply PV of CFAT, cash flow, multiply with present value at 16%. 53,000 multiply with 0.862. 0.862, that is 45,686. 53,000 multiply with 0.743, that is 39,379. Third year, 53,000 multiply with 0.641. Instead of calculating this many times, directly you can take cumulative value because the cash flow is uniform, every year same. Just to make you understand, I am using the table, separately I am doing. 53,000 multiply with 0.552, that is 29 to 56. 53,000 multiply with 0.476, that is 25 to 28. So now what is the total of PV of CFAT? 45,686 plus 39,379 plus 33,973 plus 29,256 plus 25,228, that is 173,522. So now calculate one more NPV. NPV at the rate of NPV, net present value at the rate of 16% is equal to total PV of CFAT 173,522 minus cash outflow 180,000, that is you got negative value minus 180,000, it will give you minus 6,478. So you got negative value, but you have now two NPVs are there with you. Now you will calculate IRR. How? By applying the interpolation formula. What is that interpolation formula? In previous problem also I use here. This is the formula, interpolation formula you have to apply here. See, this is the formula I applied. What is that? Lower rate of return, lower rate of return. 14% and 16%. Which is the lower rate? 14% plus, and now brackets. Present value at lower rate at 14%, 181,896 minus cash outflow 180,000 and divided by PV at lower rate 181,896 minus PV at higher rate. PV means PV of cash flow, total PV of cash flow 173,522. Multiply with difference in the two rates is difference between 14 and 16 is 2. So that equal to 14 plus brackets 181,896 minus 180,000. Sorry, here one more zero missing. 180,000, that is 1,896 divided by 181,896 minus 173,522, that is 8,374, multiply with 2, that equal to 14 plus 1,896 divided by 8,374 multiply with 2, that is 0.4545, that is 14.45% is the IRR. The internal rate of return of this project is 14.45%. So this problem in this model, there is no NPV, nothing. Directly we have to calculate IRR. So we have to calculate the fake payback period. It is also called as F, factor to be located. For that what we need? Cost of the investment, cost of the project divided by annual CFAT. The CFAT is not available in the question. So what I did, what is given? Net operating income after depreciation 34,000 minus tax at the rate of 50%, 17,000 minus. So profit after tax 17,000, add back depreciation. How you got depreciation? This one formula, cost of the project divided by life of the project, 36,000. So total annual CFAT per annum is 53,000 per annum per year. So when I use this formula here in the fake payback period factor to be located, I got 3.396. 3.396. So this 3.396 to be located in present value annuity table. In the fifth year row when I check, I got value under the column under the rate of 14%. So let us assume discount factor at 14% and calculate NPV, but I got positive value. So I need one more NPV. I have to decrease the value, so I increase the rate. So I calculate one more NPV at PV 16%. So when I have two NPVs with me, I substitute the values in interpolation formula. Many times we did this one. So now I got IRR is 14.5%. The project IRR is 14.5%. This is another problem, examination problem. And another problem I'm solving from the examination is a company is planning to purchase a machine to meet the increased demand for its product in the market. The machine costs 500,000 and has no salvage value. The expected life of the machine is 5 years. The company employs straight line method of depreciation and for tax purpose. The estimated earnings after taxes is given 50,000 per year. The after tax required rate of return of the company is 12%. So one discount factor is given already. So actually we need one more we have to calculate IRR. To calculate the IRR, we have to use interpolation formula. Before that, we need two NPVs. Already one after tax required rate of return is give 12%. So what about cash outflow? Cost of the project. Cost of the project is 500,000. Life 5 years. Every year same. And what about earnings after taxes is given 50,000, but we want cash flow after tax. So how you will get cash flows after taxes from the earnings after tax plus depreciation? So here earnings after tax plus after tax plus depreciation is equal to CFAT, cash flow after tax. So already earnings after tax is 550,000. Depreciation you can calculate easily. 500,000 depreciation is equal to, already many times I calculated same model. Depreciation is equal to life of the project 500,000 divided by cost of the project divided by life 5 years, that equal to 100,000. So CFAT is equal to earnings after tax 50,000 plus depreciation back 100,000, that equal to 150,000 per annum. 150,000 per annum CFAT. Every year same. Here there is no need to calculate fake payback period. Why? Because already NPV is given, already a rate of return is given. After tax required rate of return of the company is 12%. So required rate of return is equal to 12% already given. So you can calculate NPV. Calculate NPV at the rate of 12%. So once you calculate NPV at the rate of 12%, you will calculate one more NPV at another discount factor. The discount factor which may be above 12% or below 12%. Based on the first NPV, you will take a decision, maybe above 12 or below 12. And after having two NPVs, substitute the values in interpolation formula, and you will find out the IRR value. And the cash flow CFAT are uniform, every year same. Every year same only. So when it is same every year, as I told in my previous question, There is no need to calculate, prepare table, and there is no need to multiply 5 times. Every time 150,000 multiply with PV at the rate of 12% first year, second year, 3 years, no need. Directly you can calculate total PV of CFAT equal to 150,000 CFAT per annum plus cumulative PV at the rate of 12% for 5 years. Direct value you can take, my dear. That is 150,000 multiply with, instead of calculating 5 years every year, first year, second year, you can take the directly cumulative value 12%. At 12%, fifth year value 3 point, 3 point, that's what I told in the previous also. No need to calculate every year 150,000 into first year PV, second year PV, third year PV, no need, because cash flows are uniform. Every year same 150,000. So direct I take the cumulative value of PV at the rate of 12% for 5 years. 3.605, that equal to 150,000 multiply with 3.605, that is 540,750. And now NPV is equal to total PV of CFAT 540,750 minus cash outflow, cost of the project, initial cost 500,000, that equal to 40,750. So I got NPV. In order to calculate IRR, I need 2 NPVs. So now I have to calculate one more NPV at another rate of return. What is that another rate of return? Maybe more than 12%, less than 12%. How I will decide? I will take a decision? How I will decide? See here. NPV 540, 750 minus 50,000. IRR is the rate of return where total PV of CFAT is equal to cash outflow. This 540, 750 should become 500,000. Means this value has to decrease. This value has to decrease means rate has to increase. This value has to decrease. This value has to decrease means the rate has to increase. Rate has to increase means more than 12%. More than 12% means anything more than 12, 13, 14, 15, anything you can try. Let us calculate one more NPV at the rate of 14% discount factor. Why 14%? I have to take above 12%. Why above 12%? I have to decrease this value. Value should decrease means rate should increase. That's why 14%. And since here cash flow is same, every year same, no need to prepare tables. No need to multiply year 1 with table, year 2 with table, year 3 with table, no need. 5 times no need. Direct total PV of CFAT. PV of CFAT is equal to annual CFAT, how much per annum? 150,000 multiply with the cumulative, direct I am taking cumulative PV at the rate of 14% discount factor. Cumulative at the rate of 14% for 5 years. Direct 5 years value I am taking. From the annuity table I am taking. So that equal to 150,000 multiply with, so I will go to annuity table, cumulative table. At 14%, direct fifth year value I am taking, that is 3.433. That equal to 150,000 multiply with 3.433, that equal to 514,950. 5,14,950. So now NPV is equal to total PV of CFAT 514,950 minus, what is the cost of the project? 500,000, that equal to 14,950. So I have two NPVs with me. Two NPVs. This is NPV at the rate of 12%. This is NPV at the rate of 14%. And now IRR, I have to apply IRR equal to interpolation formula. In previous question also I solved interpolation formula. This is the interpolation formula. Many times I use this formula. Interpolation formula. What is that? IRR equal to lower rate. Where is the lower rate? Out of 12 and 14, which is the lower rate? 12% is the lower rate. So 12% plus 12 plus PV at lower rate means at 12%. What is the PV? I mean PV of CFAT 54750 minus cash outflow 500,000 divided by, again PV of CFAT at lower rate 54750 minus, I'll keep in the brackets, no confusion, divided by minus, this is 500,000, sorry, and here PV at higher rate, that is 514,950, bracket close, this one multiply with difference in the two rates, difference between 12% and 14% is 2. So let us equal to 12 plus 540 minus 500,000 means 40,000, 40,750 divided by 540,750 minus 514,950, that is 25,800, multiply with difference is 2, that equal to 12 plus 40,750 divided by 25,800 multiply with 2, that is 3.15, that equal to 15.15% is the IRR. This project internal rate of return is 15.15%. That is, at the rate of 15.15%, the NPV will be equal to 0. Total PT is equal to cash flow. At the rate of 15.15%, you will get NPV of 0. So this is the IRR calculated by applying the interpolation formula. How you got interpolation formula? For that we need two NPVs. So first, already given 12%, I calculate NPV at 12%. Then I calculate NPV one more time at 14%. Here in this problem, CFAT is uniform, every year uniform. So instead of multiplying, see in the previous problem, I multiplied 5 times. Actually, no need this one table. To make you understand, I prepared here. In this question, what I did, every year 150,000. So directly 150,000 multiply with At 12% table value, I took cumulative value, that is annuity table value I took multiplied. So I got directly total PV of CFAT 547.50. NPV equal to total PV of CFAT minus cash outflow 500,000, that is 40,750. I calculate one more NPV at 14%. How 14%? This value has to decrease, that means rate has to increase. So more than 12%, I tried 14%. Again I took the cumulative table value direct and got NPV. So two NPVs are there. This is NPV at the rate of 12% and this is NPV at the rate of 14%. Two values are there. Then I apply the interpolation formula, substitute the values in formula. The internal rate of return of the project is 15.15%. This is the one examination problem we solved. And another examination problem is here. One more problem I will solve. What is this problem here? The following are the cash flows and outflows of the project. So here here 0 here, I told you 0 here is always outflow, but one more outflow is there. Year 1 also outflow is there. So this year 1 outflow also, this is future value, you have to convert it to present value. And inflows are given salvage value at the end of the year 5. Salvage value, scrap value, residual value will be taken as income, cash flow, cash inflow at the last year of the project life. So how to calculate here cost of the project? First of all, cost of the project, 0 year 175,000 plus one more is there. Year 1 also it is there. So total PV of cash outflow is equal to 175,000 plus 550,000 multiply with, this has to be multiply because this is year 1. 0 year means current year, but year 1. So this is also future value. This future value you have to convert into present value. So at 10% table value, what is the 10% table present value? 0.909. That equal to 175,000 plus 550,000 multiply with 0.909, that is 499,950. That equal to plus 175,000. 674,950 is the cost of the project. Still now all directly we are taking cost of the project only 0 year, but in this problem you have one more outflow in the year 1. Year 1 outflow is a future value. That future value you have to convert into present value. So that's why the 5,50,000 multiply with first year table value at the rate of 5%. So 674,950. And now for NPV we need cash flows, we need PV of cash flows. Let me insert one table here. 5 years are there, so I make some 3 columns I will make, and I'll make this one. This is year and this is cash flow. What is given here? Cash inflow, direct cash inflows, and this is PV at the rate of 10%, and this is PV of cash inflow. Cash inflow, cash flow, cash flow after tax, CFAT, all are same only. 1, 2, 3, 4 and 5. I need one more column because for total purpose, and let me remove this one. and remove underline also, unnecessarily you will confuse. So what is the cash inflow given? 35,000, 45,000, 65,000, 85,000, 50,000. One more is, see, the salvage value at the end of 5 years. I told you before also, salvage value, scrap value is also taken as a inflow, taken as a cash inflow. So that's why I took here 50,000 plus 50,000. What is another 50,000? That is salvage value. What about table values? Already I have before table values many times. So just I copy paste from there instead of calculating again and again, typing. I took directly from there. I took paste. So here copy paste table values, and now PV of cash inflow, that is cash inflow table values PV. 35,000 multiply with 0.9, that is 9, that is 31,815. 45,000 multiply with 0.826, that is 37,170. 65,000 multiply with 0.751, that is 48,815. 85,000 multiply with 0.683, that is 58,055. And last year 100,000 multiply with 621.621, 62,100. Now calculate the total, all five values total PV of CF80. 31,815 plus 37,170 plus 48,815 plus 58,55 plus 62,100, that is total 237,955. Total PV of CF80 is this one. And calculate NPV is equal to, you know already, total PV of CF80 237,955 minus total PV of cash outflow, that is 674,950, that equal to negative value we got 674,950, that is we have minus 436,995 is negative NPV. Why negative means here cost of the project 175 outflow, but year one he gave 5,50,000, so 2,000, so too heavy out project. But inflows are this one. So in this problem, NPV is negative. So the important thing is cash outflow is 0 year and also year. So year one outflow is a future value. That future value should be converted into present value. That's why I multiplied with the first year PV table value at the rate of 10%, 0.909. So total 674,950. Then cash flows. Then PV at the 10%, PV of cash inflow. Here salvage value is taken as cash inflow in the last year of the project, life of the project last year. So that's why I took here 100,000, and if you multiply total cash flow, I got only 237,955 minus cost of the project, I mean cash outflow is 674. So outflow is more than, so that's why you got NPV negative. Since the NPV is negative, generally the project should be rejected. So these are the another problem, examination problem here. Very important here. Outflow is converted into inflow, 1 year, and here you got negative. I think one more problem is there to solve. Examination problem. What is that? Equipment A has a cost of 75,000 and net cash flow of 20,000 per year for 6 years. A substitute equipment B would cost 50,000 and generate net cash flow of 14,000 per year for 6 years. The required rate of return of both the equipments is 10%. Calculate NPV and PI for the equipment, suggest which should be accepted and why. So this is another problem, examination problem. Two equipments are there. For two equipments, you have to calculate NPV and PI and check which is accepted, which is rejected and why. First of all, equipment Y, equipment A calculation. And here equipment A, started calculation. NPV, total PV of CF80, cash flow minus cash outflow. What is the cost of the project? Cost of the project is given. How much? 75,000. What about cash flows? Net cash flow, yes, direct cash flows are given. Cash flow, how much? 20,000 per year. Every year same per year. So when the every year same, no need to prepare a table and multiply every year, multiply with first year value, second year value, no need. And what about the life of the project? Life of the project is 6 years. So 6 years you will get. What about the rate of return? I mean discount factor, required rate of return. Required rate of return, or it is also called as discount factor. Generally everywhere 10% only, equal to 10%. So now I want total PV of cash flow is equal to cash flow for year 20,000 multiply with direct cumulative table value at the rate of 10% for 5 years. For 6 years you have to take directly. That is how you will calculate. That is 20,000 multiply with, go to the annuity table. In annuity table, 10% column, take the 6th year value. 6th year value annuity table is 4.355. When the cash flow is uniform, every year same, no need to calculate, no need to prepare a table, no need to calculate every time with first year with table value, second year with table value, third year table value, no need of calculating. Directly cash flow per year multiply with a 10% 6th year cumulative table value. You have to take cumulative table value at 6th year. 6th year you have to take it. Direct 6th year 4.355. That equal to 20,000 multiply with 4.355. 20,000 multiply with 4.35, that is 87,100. 100. Good. Now NPV, what is the formula? Total PV of CF80, 87,100 minus cash outflow, cost of the project 75,000. That is 87,100 minus 75,000. That is 12,100. Very good. What about PI? Profitability index equal to total PV of CF80 87,100 divided by 75,000. NPV will give you value in amount. PI will give you value in ratio. That's it. 87,100 divided by 75,000. That is 1.16. So this is about the equipment A calculation, equipment A calculation. Now equipment B I am doing, please check, edit, copy, paste. So now I have to do equipment B. Check carefully, I am doing equipment B. Yes. What is the cost of the project? A substitute equipment B would cost 50,000. Yes, this is 50,000 cost of the project. What about cash flow? And generate net cash flow of 14,000 per year. Sorry, so this is 14,000 for 6 years. What is the required rate of return? Both equipments is 10%. So 10% only. So how I will get total? Here also every year same 14,000. So no need of tables. No need of multiplying 6 times, directly 14,000 multiply with cumulative table value at 10% per 6th year. At 6th year I took directly. So here 14,000 per annum, 14,000. So 14,000. Project B I am calculating for equipment B. Equipment B. 14,000 per annum multiply with direct to 10% 6th year annuity table value, because no need to multiply 6 times, because cash inflow is uniform every year same. 4.355, that is 60,970. Now NPV equal to total PV of CFAT is 6970 minus cash outflow, cost of the project 50,000, that is 10,970. What about PI? 6970 divided by 50,000. Sorry, what is the cost of the project? S, cost of the project 50,000. So minus 50,000 cost divided by 50, that is 60 divided, I thought 60,970 divided by 50,000, that is 1.21. Now check, what is equipment A NPV? 12,100. Equipment B NPV 10,970. So based on NPV, which one will choose? Equipment A is selected. But coming to the PI value, profitability index, A is 1.16 and B is 1.21. PI is giving more for equipment B. So now decision. Based on NPV, equipment A should be accepted as its NPV is maximum or high. That is the decision. NPV is maximum for equipment A, 12,100. That's why based on NPV, equipment A should be accepted. Based on PI, profitability index, equipment B should be accepted as its PI is maximum or high. So my dear, in this question, when you want to write a decision based on NPV, NPV is maximum in case of here 12,100 and here NPV is 10,970. So A is high, that's why based on NPV, equipment A should be accepted as NPV is maximum high. What about PI? Here PI is 1.16. Here PI is 1.21. When comes to PI, equipment B is maximum. That's why see, based on PI, equipment B should be accepted. As its PI is maximum or high. So based on NPV, decision is different. Based on PI, decision is different. So these are the various examination problems. Here also cash flows are uniform, every year same. So directly I multiplied with the table value at the rate of 10% for 6th year cumulative value. That means annuity table directly I took 4.355. I took from the annuity table value direct. 6th year annuity table value at the rate of 10%. So when coming to the decision and suggest which should be accepted and why, coming to the NPV, A should be accepted because NPV is high. Coming to the PI, B should be accepted because PI is high for project B, equipment B. So these are the various examination problems I solved covering all the methods. 2 traditional methods, 3 discounted cash flow methods. Few more methods are there. Discounted payback period method, terminal value method, but these are the main important methods. So different examination problems I solved here. Please go through all the problems, and if you have any doubts, you can write a mail to me or you can mention in the comment box. You can write a mail to me, Dr. Harikarri, DRHARIKARRI @gmail.com, or you can mention in the comment column also if you want me to solve any extra problem, any additional problem if you want me to solve. You have any question to solve, doubts, anything, you can send me an email or you can mention in the comments column dear. So this is about the various capital budgeting methods, examination problems and solutions solved here, previous examinations. If this information video is useful for you, then please subscribe and share it to all your friends. If you have any doubts, any clarification, any additional problems you want me to solve, mention in the comment column or write an email to me. Thank you very much. Have a good day.